In this class, I will share with you more on the fraud and financial crime, and we'll start with the topic on fraudulent financial reporting, and then followed by money laundering. To conclude this chapter, I will share with you some of the implications, preventions, and management responsibility on fraud. So let's start with the discussion on fraudulent financial reporting. The fraudulent financial reporting involves intentional misstatements in financial statements in order to deceive financial statement users. The example like including omissions of amounts or disclosures. If you remember what we discussed in our another class, fraud is the intentional acts. And there's opportunities and motivations for those dishonest people to do fraud. So for fraudulent financial reporting, there's a motivation, say for the management, to misrepresent or to intend misstatements in the financial reports. And usually for those fraudulent financial reporting, the schemes can be referred to as cooking the books, creative accounting, or earnings management. I will share with you some of the examples for fraudulent financial reporting later. And all these schemes may or may not comply with the letter of standard accounting rules, but they are usually contrary to the spirit of these rules. Here is some tricky points for fraudulent financial reporting. Sometimes for fraudulent financial reporting, it's not very clear whether it is complying with accounting standards or not. And in our examples, I will share with you more on this. So let's share some of the examples of creative accounting. First, window dressing. For window dressing, it involves misrepresentations of information, such as the entering into the transactions before the year end that are often reversed out after the year end, and the substance of which was primarily to improve the appearance of the company's financial statements. In other words, before the year end, let's say by end of December, the company target to have 10 million sales in December in order to achieve the full year target. But at the end of the month, it is close to the end of the month in December, but the possibility to achieve 10 million is quite rare. Say the company is confident to deliver only 9.5 million sales. The management can think about window dressing, for example, to sell goods to a particular customer before end of December, and it can close up the full month numbers to 10 million. At the same time, the company issue a credit note to a customer, and the credit note is effective on January next year. In other words, by January next year, the customer can pass through back the credit note in order to reverse the sales. It's a typical example for fraudulent financial reporting. Another trick is if a company decides to achieve 10 million sales in December, and it looks like it's quite far away, say only achieve 9.5 million. A trick is the management can discuss with some customers and negotiate with them by granting them a huge discount if they can pick up the sales orders before end of December. And if it is the case, so-called the year-end promotion or year-end discount. If it is the case, it is quite hard to argue whether it is a fraudulent financial reporting or not, because the management can claim it is just a year-end promotion or discount. And in the discount example, it is not violating any accounting standards or even any legal or law. Another example is delaying or accelerating a company's expenses, showing an expense as an asset on the balance sheet rather than writing it off immediately against profits. For any expenses delayed, the intention is to improve the profitability of the companies. And sometimes it is contrary to acceptable accounting practices. But on the other hand, if a company decides to accelerate the expenses, what's the intention? The intention may be in next year a new bonus scheme will be launched, and the management or senior management, they think it's impossible to achieve the bonus target or the sales target or the profit target in this year. So they accelerate the company expenses by asking the suppliers to issue the invoice earlier than usual, and the company pay all the invoices before end of the year and recognize all the expenses item. It helps to improve the profitability in the following year. At the same time, if a new bonus scheme is launched next year, it is also an intention for the management to move the profit from this year to next year in order to achieve the new bonus target. Third, inaccurate evaluation of company's assets. An example is like to inflate the value of the company's asset, so the company has the evaluation gain. By holding the asset, it helps to improve the profit and loss situation. And fourth, manipulation of revenue recognition. It is quite often for fraudulent financial reporting. Sales are recorded as soon as goods are ordered by customers rather than when they are shipped to the customer. The problem is not only happened for those so-called offline sales. The internet sales can also be manipulated by recognizing the sales when the customer placed the order online. Once an internal auditor found it is not a regular practice, then they will raise an issue, or they will raise it to the senior management, and further investigation may be needed. And the fifth example here is off-balance sheet accounting. So what is an off-balance sheet? That means the items cannot be recognized on the balance sheet. Say, for example, the lease liabilities or the right of use assets. In the latest example, like the short-term lease, under the latest accounting practices, you do not have to show the asset or the related obligation to pay, that is the liability, to pay the rental amounts on the balance sheet if it is within 2-year lease term. And company can decide the lease term is within 2 years, so it no need to recognize the obligation to pay the rental amounts on the balance sheet. It is one thing the companies can manipulate its financial statements through so-called off-balance sheet accounting. Here is a description of teaming and nailing. It is a juggling fraud normally within the sales system, whereby the receipts of later debtors are allocated to pay off earlier debtors. So let's see how it works. For example, here, the sales happen in day 1, and the cash will be received on day 8. So on day 2, the sales or the invoice issued on day 2, the cash collection will be on day 9. So this pattern creates an opportunity for the accounting staff or any person managing the cash receipts to have the opportunity to have fraud. And the methods to discourage teaming and nading frauds include: first, rotating duties within the accounts department. If the accountant reconciles the cash receipt against the invoice issue, say the account receivables outstanding balance, if he knows he no needs to take turns with others and he doesn't take any annual leave or holiday, it means that he has the opportunity to manage or the booking of the numbers. Recall the previous example here. When the money got from the customers on day 8, the accountant can pocket the money with him and not deposit into the bank account. Until day 9, he received another cash payment by the customer, and he matched this day 9 receipts with the first day or day 1 sales, the invoice issued on day 1. So in other words, under this mechanism, if there is a day 9, day 10, and with a day 3, day 4 sales, and with day 10, day 11 cash collection, the amount received on day 8 cannot be easily found in the system, because for all invoice issued from day 1, it seems they are all settled and no need to care about it. So here, one way to discourage teaming and nading is rotating duties within the accounts department. That means no one can manipulate it. And next, insisting that everyone takes their annual holidays. Is clearly understood. It's quite similar to what in the first statement. Thirdly, sending regular receivable statements. In other words, you have the receivables balance from your customer. You send a monthly statement to them so they will confirm with you, or they will argue with you if it's not correct. Internal audit could carry out a circularization of receivables, asking them to confirm the balances that they are recorded as owing to the company. It's quite similar to what in point 3, the account receivable statements. Internal audit, if they would like to have the investigation of a particular, say, receivables, they can send the confirmation to the customer and ask them to confirm the balances. Another method to discourage this is employing honest employees in the first place. For example, checking references given by job applicants when they apply to work at the company. So in other words, with a good reference or track record, the applicants will get the job more easy than the others, because they can protect the company's interest. So next, money laundering. Money laundering is the exchange of dirty money and assets. So it's not only money, assets as well, that have been criminally obtained for clean money, and assets that have no clear link to criminal activity. In other words, when you got the money through the criminal activities, for example, like selling drugs or smuggling any illegal items to have your money back, and you try to clean those money and assets that have no clear link with your criminal activity, that is called money laundering. And typical money laundering legislation recognizes 3 main offenses relating to money laundering. First, by laundering itself. It means the people who do the money laundering. This may involve acquiring, using, or processing criminal properties, handling or being involved with criminal activity, investing the proceeds of criminal activity, or transferring criminal property. In United Kingdom, it carries a maximum of 14 years prison sentence along with fines. In other words, if you do the money laundering, no matter you are transferring your money or investing the proceeds, all these activities related to your benefits obtained through the criminal activities, you will be in prison for up to 14 years in UK, if it happens in UK. Apart from laundering, failure to report. That means any person who is failing to disclose proof or suspicions of money laundering can carry a maximum 5-year prison term along with fines. In other words, you know it happens, but you didn't report, then you are still liable for the money laundering by 5-year maximum in prison. Tipping off means, yes, you report. For example, you are not failed to report, but the disclosure of information which may prejudice a money laundering investigation carries a maximum 5-year prison term. In other words, you report, but your information provided may prejudice a money laundering investigation. That is, make the bias in the judgment. You also be caught for money laundering, like 5-year maximum in prison. So here we just share some about the legislation on money laundering. And let's see the phases of money laundering. We found there are 3 distinct phases for money laundering. First, placement. This refers to the placing of illegal obtained cash or assets into a legitimate business. For example, or that is the purchase of shares in a company with stolen money. So you stole the others' money into your pocket and invest this money into shares. You try to place your illegal obtained cash or assets into a legitimate business. Just investments. So here is the first phase. The second phase is layering. That is, the money transfer between businesses or locations to conceal their original source. For example, you transfer your money between banks to make its original source harder to trace. Is layering. The example we just mentioned about buying the shares, you buy the shares and sell the share in the market to obtain the cash back and invest another company's shares as well through the stock exchange. You just sell and buy to have a lot of transactions. The purpose or intention of it is to have the layering of your money to make it harder for the investigations to trace. So the final phase is integration. After placement and layering, the money now appears to have come from a legitimate source because you are just trading stocks. And after layering, the money now appears to have come from a legitimate source. That is, your money is just back from stock trading. It's not from your criminal activities. So here is the process of money laundering, from the placement, next to layering, and then is integration. And in many countries, banks and money changers are required by the law to put in place controls and procedures to identify money laundering transactions. So it's quite hard for banks and money changers to do it if it is a small scale. But if a big banks or banks with a size, with good number of staff, and for money changers as well, they need to identify the money laundering transactions by performing so-called the KYC practice, the know your client practice. So here are some of the procedures that I would like to highlight. First, as I said, the banks and money changers, they need to perform the KYC, know your client practice. The first is to identify of large or unusual transactions. So they know it. They have to do it. If any unusual transactions or large items, so they can check whether this client is appropriate for doing it. Next, scrutinizing of unusual patterns of transactions. If a new customer just come to the banks or money changers would like to change, say, the foreign currency, the local currency into foreign currency, then and with a huge amount, then it is not usual. So it's unusual patterns of transactions. They need to scrutinizing it and check. So once they identify large or unusual transactions, and they need to take steps to ensure all customers can be identified. So I just mentioned it's about the KYC. Know your client procedures. If you don't know your clients, but you accept the transactions, then it's the responsibility of the banks or the money changers, because they need to take steps to ensure all customers can be identified for any unusual or large transactions. And next is to create a role called money laundering reporting officer. It is an employee who will be responsible for oversight of the organization's money laundering activities, and who employees can report any suspected money laundering activities to. In other words, this MLRO is a key person in the bank and money changers, because for any staff in the company or in the banks or money changers, they need to report to him or her on unusual transactions or unidentified customers putting the money into the bank or the money changers. So the creation of this role is very important, because they listen, or not only listen, they need to work with all the staff here to ensure there's no money laundering within the bank or the money changers. Another procedure here is to undertake appropriate customer due diligence. It's more or less the same as on point number 3. Identify the customer, but once the customer identified and you think you need to know more because about the KYC, know your client practice. If you need to know more, you have to perform the customer due diligence as well. This involves the organization acting to ensure that its customers are who they claim to be. So here are the key controls and procedures for banks and money changers required by law to do it about money laundering transactions. And it is also important that a business has a defined reporting process for any suspected money laundering. Like the bank or money changers, for employees in those organizations, they need to report suspicious activity to the MLRO. For many big companies or organizations in the world, like some of the multinational companies, they have their internal MLRO as well, the money laundering reporting officer. So the employees can report to him or her about any suspicious activity. And when the MLRO, the officer, he or she can investigate further about the cases submitted by the employee. And if there are grounds for reasonable suspicion, the officer can report directly to the relevant authorities. It's very important because, especially for the bank, if any suspicious transactions identified by the money laundering reporting officer, the officer will work or will disclose to the, will report to the authorities, and will work with the authorities as well. So here is the last section of this class, as well as the last section on this chapter on fraud and financial crime. I will discuss about the implications, preventions, and management responsibility on fraud. So there's a fraud. So what's the possible implications of fraud to a company? First, loss of shareholders' confidence. It's very important because if the shareholders' confidence lost, the company's valuation will decrease as well. And it's not immaterial, it's critical. Because once the loss of shareholders' confidence, then it means the share price drop, a lot of wealth will be disappeared. It is not immaterial, right? And next, loss of assets. For fraud, another concern is whether the company's directors, management or staff, or even third parties can have fraud with the organizations and some of the assets lost. Say we shared before that the misappropriation of assets, like for example, if the management have fraud on the factory, on the machineries, they can claim the machineries cannot be used anymore to write off in the accounting or in the financial book. But in fact, the machines are fine, the conditions are good, they can resell the machines and cash in the money. So it's a loss of assets. Financial difficulties. If the fraud is uncovered and disclosed to the public, and it may trigger the bank to recall the loan, or the supplier, they don't want to, or the customer, they don't want to pay to the company as well, and it creates the financial difficulties. And the collapse of the company is the worst, almost the worst, because the company trust is gone. And imagine if it is a bank, a significant or severe fraud issue within the bank. So whether you are confident to put your money in the bank, no. So if no one would like to put the money in the bank, and the consumer, the customer put the deposit into the bank, they would like to withdraw the money back, the bank will be collapsed. So the same for other organizations. If there's loss of confidence by your customers or by your supplier, then it's a risk for the company to be collapsed. And fraud it is illegal, or there's a violations of local law, then the fines by the tax and other authorities can be happened. So what are the measures to prevent and detect fraud? And if you can recall what we share with you about the importance of internal controls to avoid fraud or errors, no matter in this class or another class, then you can have an idea of an effective internal control system is the key or the principal strategy here to prevent and detect fraud or error. So let's see, or let's recall the 5 components of internal controls here. First, the control environment is the overall attitude of management regarding internal controls and their importance. And another component of internal controls is the entity's risk assessment process. Third, the information system and communication. It is relevant to financial reporting objectives, consists of the procedures and records established to process the transactions that the entity carries out and to maintain accountability for the related assets, liabilities, and equity balances. So the 4th component is control activities, and the final or the 5th component here is the entity's process to monitor the system of internal control. So how's the practice? Like, any examples for you to learn on these 5 components in practice? Yes, for sure. The control environment, for example, a formal organization structure assigns authority and responsibility throughout the company. It is not just an attitude. The management show through example, say for example, to have a sense of authority and responsibility throughout the company for the control environment here. And for entities risk assessment process, the companies can employ IT experts who can advise on incorporating new technologies into the production process. Then it helps to identify and respond to business risk. And third, information system and communication. The monthly management accounts or reports are submitted to senior management so that they can monitor the company's performance on a timely basis. So once you have the information shared in the senior management understand what the business is going on, and it helps to minimize the risk. Fourth, the control activities. The example say segregation of duties is enforced in the accounts department. So there's a policies and procedures on how to book or to do the reconciliation, like the cash receipts to the account receivables. Then it helps, the control activities helps to minimize the risk. And another example for the fifth component here is internal audit are charged with reviewing the effectiveness of internal controls throughout the business. So in other words, the internal audit has the cycle audit, or they can review the procedures and process within the company to ensure they are effective. So the first step of any fraud prevention system is therefore to ensure that each of the 5 components, as we mentioned, is set up and working properly. And we also share some examples. So for internal controls, all internal controls play a role in helping to manage the risk that are significant to the achievement of companies' objectives. So it's no doubt that the strong internal controls can help to prevent, to detect fraud, prevent fraud, and to minimize the risk of fraud. And since a company's objectives and the environment within which it operates are constantly evolving, so it's a dynamic environment, the risk it faces are continually changing. In other words, if an internal auditor performed very good jobs in last year, it doesn't mean that the risk is gone. And in this year, there's no risk. No, because the business environment is changing, people will keep changing as well. So the risk it faces are continually changing, and internal auditor need to review what's the latest development and to decide what kind of internal audit procedures need to take into for the organization. An effective system of internal control therefore requires a regular evaluation of the risk to which the company is exposed. So it's not just a one-step process, it's a continuing process for internal controls as well as the internal audit work. So let's move on to talk about some of the duties of management and other senior members in the organization. First, the duties of management. It can be divided or split into different areas. First is about the board of directors. The board of directors, they need to maintain a sound system of internal control. It's their responsibility, as we share with you in other class about the responsibility of board of directors on internal control. And for audit committee, the duties is to monitor and review internal control and risk. Remember, for audit committee, they need to work with external auditor and internal auditor to make sure the internal controls are in place in the organization. So it's their work to review and monitor the internal control. For employees, it includes the senior management as well, include fraud prevention and detection. So maybe through training, education, or rewards, for example, to employees to help prevent fraud and detect the fraud as well. And in some countries, say for example in United Kingdom, for the board of directors is required by the UK Corporate Governance Code to maintain a sound system of internal control, and the board should conduct a review on a year basis. That means on every year they need to review the effectiveness of internal control system and report to shareholders. So for United Kingdom is the case, but not for others, but it's a good practice for board of directors to review the internal control systems on a regular basis. So now this task I will share with you 2 questions to let you think about what we discussed. First question, for teaming and lading frauds cannot be carried out within the purchases system. Is this statement true or false? Remember, our example is on sales, but this question is about purchase. So whether you think it cannot be carried out in the purchase system, you think about it. Another question is, a bank employee becomes suspicious of a customer who has made several large deposits of cash into their account. The employee is concerned they may be laundering money. So it's suspicious. Who should the employee report this suspicious to? Whether it's the customer, direct to the customer, talk to them, I think you are money laundering, whether it's the answer, or the police directly, or immediate line manager, that is maybe he is, say, the frontline department, so he a branch, or the bank branch, and then he reports to the branch manager, or D is the money laundering reporting officer. So remember what we shared with you before about this role or this process on reporting process about money laundering. So once you remember this chart, then you can answer this question.